Okay, let's unpack this California, the Golden State. For so long, it's been, synonymous with sunshine, innovation, and this almost mythical promise of ever-rising home values.
Absolutely. Owning a piece of that dream felt like a guaranteed investment, didn't it? A real cornerstone of financial security for many.
Exactly. But what if we told you the very ground beneath that golden dream is starting to shift dramatically, and not just from earthquakes.
Intriguing.
We're talking about a significant, undeniable cooling in the housing market. It's such a stark contrast to the booming years we've all kind of gotten used to.
A real shift in the narrative.
Yeah, listings are piling up, prices are sliding, and for the first time in what feels like an age, buyers are finally getting the upper hand.
That's a big change.
So today, we're diving deep into the nitty-gritty of the Golden State's real estate landscape. We've gathered a fascinating array of insights that reveal where prices aren't just expected to drop, but are already showing significant slides in 2025.
And crucially, why this is happening.
Right. Most importantly, we're going to uncover the intricate tapestry of reasons why. From the glitzy hills of LA to the tech heartland of San Jose, even the more affordable spots. Prepare to rethink everything you thought you knew about California real estate.
What's truly fascinating here, I think, is how a confluence of powerful forces, you've got stubbornly high interest rates, the whole evolving landscape of remote work,
Right.
and even the very real and, frankly, increasingly burdensome cost of home insurance. They're all converging to create this genuinely unique moment in California's housing history.
It really feels different this time.
It does. For years, the narrative was simple. Buy here, value goes up, period.
Yeah.
But the current dynamics are just far more nuanced, far more complex. They really demand a closer look.
So that's what we're doing.
Exactly. We're going to break down the specific market dynamics in 9 key cities, moving well beyond the sensational headlines to help you understand the deeper undercurrents shaping tomorrow's market.
Giving listeners that context.
Our mission is to give you that shortcut to being well-informed about this critical topic, providing the context, the specific data points you need to grasp the full picture of this profound shift.
So what does this deep dive mean for, say, prospective buyers who've been waiting on the sidelines?
Good question. And for current homeowners wondering about their equity.
Yeah, their hard-earned equity.
And really, for anyone just trying to understand the broader economic landscape.
Let's explore the data together then. Okay, first up, it's the city of dreams, Los Angeles. Always sparkling, right? Palm-lined streets, luxury homes, that irresistible Hollywood dazzle.
It has that iconic image, for sure.
For decades, it felt like this unstoppable force in real estate, constantly pushing boundaries, setting new highs. Yet, as we move into 2025, behind that glamorous curtain, we're seeing undeniable signs that its housing market is starting to slip.
And surprisingly fast, you mentioned.
Yeah, surprisingly fast. The once unyielding momentum that defined LA's property values, it seems to be losing its grip. It's revealing a surprising vulnerability even in this, iconic metropolis.
Well, the indicators of this slowdown are quite clear when you delve into the numbers. Across LA County, median home prices are currently hovering around $850,000.
Still a huge number.
Oh, absolutely. A substantial figure. But we're beginning to observe actual price drops in various neighborhoods. We're talking 2% to 4% compared to this time last year.
Okay, 2 to 4%. What does that mean in real dollars on an average home there?
Well, to put that into perspective, for a home costing, say, nearly $1 million, even a 2% dip translates to a tangible reduction of roughly $17,000.
Wow, okay. That's not insignificant.
It's not at all. That's real money, and it sends a clear signal about changing market sentiment. And beyond just the price adjustments, we're witnessing a significant surge in available inventory.
More homes for sale.
A lot more. The number of homes listed for sale in LA is up over 50% year over year.
50%. That's massive.
It is. What this means on the ground is that for every 2 homes available last year, there are now 3, a much larger supply.
But are the buyers there?
That's the crucial part of the equation. Fewer buyers are actually stepping forward and committing to a purchase. This growing imbalance inevitably shifts power away from sellers.
Okay, so sellers must be feeling that pressure.
Indeed they are. You can see it in their behavior. Over 40% of listings in early 2025 had price reductions.
40%? What was it before?
That's a sharp, remarkable rise from just 22% 2 years prior.
Wow. Double almost.
Pretty much. And this isn't just, an anomaly confined to the ultra-luxury enclaves like Beverly Hills or Malibu.
Right, not just the mansions.
Exactly. We're seeing this trend extend to mid-tier, more accessible neighborhoods too. Places like Northridge,
Family-friendly area.
right, West Adams, historically rich, rapidly gentrifying,
Yeah.
and Eagle Rock, popular for its vibrant community, unique architecture. They're all experiencing this cooling off period.
So areas where like regular people buy homes.
Precisely. These are areas where the everyday buyer typically operates, and their cooling indicates a broader, more systemic market trend. The consequence for sellers. Buyers are now in a position of strength,
Negotiating hard.
negotiating much harder than they have in years, and frequently closing deals for amounts under the original list price.
That's a huge change for LA.
It's a profound change, moving from that aggressive seller's market to a more balanced, maybe even buyer-favored environment.
That's a significant rebalancing. So beyond just sellers reacting to fewer offers, what are the core underlying forces reshaping LA's property landscape? It feels like there are bigger systemic shifts at play here.
There absolutely are. While the affordability crunch from high mortgage rates is a statewide issue, LA's market is particularly sensitive due to its unique blend of factors, those 30-year fixed rates, still hovering stubbornly around 6.8% to 7%.
Still up there.
Very much so. Now consider the monthly payment on an average LA home, that $850,000 figure. With a 20% down payment, that payment is now over $5,500.
Wow. Just for the mortgage, principal and interest.
Primarily, yes. Now compare that to just $3,800 back in 2020.
That's a $1,700 difference per month.
It's astronomical for many households. It's effectively pricing a huge chunk of would-be buyers out of the game entirely. Even those with solid incomes find the debt service simply unmanageable.
And LA's economy, is that playing a part?
It is. While diversified, it relied heavily on sectors like media and entertainment, which, as you know, have seen significant contraction and layoffs recently.
Yeah, lots of headlines about that.
Right. This directly impacts the confidence and purchasing power of a substantial segment of high-earning potential buyers who previously drove a lot of the demand.
Okay, that makes sense. And you mentioned insurance earlier.
Yes, and this is perhaps most uniquely painful for California, and it's acutely felt in LA. The deepening home insurance crisis.
The wildfire risk factor.
Exactly. In wildfire-prone zones, which unfortunately cover substantial portions of Los Angeles and the surrounding areas, major insurance companies like State Farm and Allstate have drastically pulled back.
They're just not writing new policies in some places.
Correct, or they've stopped issuing new policies altogether in high-risk zones. This makes home insurance incredibly difficult to secure.
And more expensive if you can get it.
Significantly more expensive. We're talking adding hundreds, sometimes thousands of dollars to monthly housing expenses.
Ouch. On top of the higher mortgage payment.
Precisely. This additional burden further erodes affordability, forcing more potential buyers to reconsider or even abandon their homeownership dreams in the city. The cumulative effect is creating a powerful deterrent.
The bottom line is Los Angeles still looks glamorous on the surface, right? It shimmers with its iconic appeal, but the market underneath is definitely flickering. With rising costs, fewer active buyers, and that growing inventory signaling weaker demand,
Yeah.
the City of Dreams could genuinely turn into a real estate cautionary tale in 2025. It's a sobering thought for a market that has historically seemed, well, invincible.
It really is.
Yeah.
The major shift.
Okay, so from the glittering, high-stakes market of LA, let's turn our attention north, inland, to Stockton, a city with a real estate reputation for, well, roller coaster rides.
That's putting it mildly, especially after 2008.
Right. Tragically, ground zero in the devastating 2008 crash, home prices plummeted by over 50%. The city even filed for bankruptcy. It was rough.
Extremely rough. A very difficult period for Stockton.
While things look considerably more stable on the surface now in 2025 and, a repeat of that catastrophe isn't foreseen,
Hopefully not.
cracks are definitely starting to show again. It suggests that while history might not repeat itself exactly, it often rhymes, as they say.
That's a good way to put it. And Stockton's market indicators are indeed flashing some serious warning signs that warrant attention right now. Median home prices there recently peaked around $480,000.
Which was a big recovery from the crash levels.
A very significant recovery and period of growth.
Yeah.
However, over the past few months, we've observed a noticeable dip in prices, roughly 3%.
Okay, 3%. Sounds small, but
Well, in isolation, maybe. But many analysts are interpreting this as just the beginning. They're projecting further declines as the market continues its adjustment.
what other signs are there? Inventory.
Inventory is a key indicator. The number of homes for sale has increased by over 45% year over year.
45%. Again, a big jump.
It is. And what that means on the ground is that homes are sitting on the market for significantly longer periods. The days on market metric, that's how long a property remains active before selling it, jumped from a relatively quick 27 days
Pretty fast.
to a much longer 44 days in just 1 year.
That's a big slowdown in sales pace. Gives buyers time to think.
Exactly. This extended time allows buyers to pause, breathe, and crucially, to negotiate effectively, a luxury they really haven't had in years in that market.
So are sellers cutting prices like in LA?
They are. In response to this changing dynamic, sellers are increasingly lowering their asking prices. Nearly 38% of all listings in Stockton now show price markdowns.
38%. How does that compare nationally?
That's almost double the national average for price reductions.
Wow. Okay, so Stockton sellers are feeling it.
They definitely are. While we're certainly not talking about a full-blown crash yet, the overall energy of the market has undeniably shifted. It's gone from that frantic buying spree to a more cautious wait-and-see approach.
That's a dramatic shift in energy for Stockton. What's uniquely causing this significant pivot, especially given its history, is it like a reversal of the trends that fueled its growth during the pandemic?
That's precisely it. You've hit on the crux of the matter. Stockton experienced a considerable boom during the pandemic, primarily benefiting from an influx of Bay Area buyers.
Right. People moving inland for space and affordability.
Exactly. With the rise of remote work, people were looking for more space, more affordable housing, and Stockton, being within a, let's say, reasonable commuting distance of the Bay, became a prime destination.
But that's changing now.
That dynamic is now undergoing a significant reversal. Remote work policies are becoming less permanent. More companies are calling people back.
Return to office mandates.
Right. Or workers are just opting to live closer to urban centers again for lifestyle reasons. This means that once steady influx of Bay Area buyers, who were really key to boosting Stockton's market, well, that's slowing significantly. It removes a key pillar of demand.
Okay, so the external demand is weakening. What about internal pressures?
The broader economic pressures are certainly taking their toll. Rising mortgage rates, still hovering near 7%, coupled with tightening loan requirements, are hitting affordability in Stockton especially hard.
Even with lower prices than the Bay Area.
Even so, those rates make monthly payments daunting for local residents, particularly when you consider the average income levels there.
And the local job market. You mentioned that's a factor.
It's a critical underlying factor. Stockton's job market remains shakier than the state average. The unemployment rate is currently around 7%.
Which is higher than California overall.
Notably higher, yes. And wages in Stockton also continue to lag behind the state's major urban centers. This combination means that even with relatively lower home prices, many local residents simply can't afford new homes.
Especially when you add in rising insurance and taxes.
Exactly. Those are rising statewide. This economic uncertainty creates a profound sense of hesitation among potential buyers. Plus, there's this growing trend of younger buyers specifically choosing to wait.
Waiting for a better deal.
Waiting, hoping that if prices continue to decline, they might secure even better deals in the coming year. That further reduces immediate demand right now.
History tells us Stockton tends to swing harder than most markets during downturns, kind of an amplified response to broader economic shifts. While it's certainly not in a full crash yet, those warning signs are flashing bright red.
They really are.
2025 might just be the year Stockton shifts from hot to not, moving from that rapid growth phase to a significant cooling period, reminiscent of its past volatility, but hopefully, like you said, without the same catastrophic outcome.
Let's hope so.
Yeah.
But the signs are concerning.
Okay, moving east from the immediate coast now, towards the Inland Empire. Riverside. This was once the go-to affordable alternative to LA, wasn't it?
It absolutely was. A place where you could still genuinely buy a home without those crazy auction-style bidding wars and frantic competition.
It symbolized a more attainable piece of the California dream for a lot of people. But in 2025, even the Inland Empire isn't immune to California's sweeping market shakeup.
No region seems to be entirely shielded.
It seems the appeal of affordability alone is losing its once potent power.
The market data clearly illustrates this shift in Riverside. The median home price in Riverside County recently hovered around $575,000.
Still less than LA or San Diego, but up significantly from a few years ago.
Definitely. However, we're now seeing this figure sliding down by about 2.5% year over year.
Okay, 2.5% decline.
While not a dramatic collapse, it's a significant reorientation, especially considering Riverside experienced nearly 40% growth during the pandemic boom.
Wow, 40% growth back then, so any drop feels big now.
Exactly. For a market that saw such rapid appreciation, Any downward trend feels substantial and indicates a change in direction. But the most pressing issue right now is the surging inventory.
Like elsewhere, how much is it up?
The number of homes for sale in Riverside County is up by nearly 50% compared to early 2024.
50% again? That seems to be a common theme.
A very common theme.
Mm.
This massive increase in supply means that homes that once flew off the market in under 2 weeks
Literally days sometimes.
are now sitting for over 40 days.
40 days. So buyers have much more leverage.
Considerable leverage and the opportunity to be far more selective. Consequently, sellers are actively adjusting their expectations. Nearly 36% of all active listings are now seeing price cuts.
36%. Another high number.
It's a clear sign that it's quickly becoming a buyer's market. Sellers are scrambling to adapt to this new reality, recognizing that the days of multiple offers and aggressive bidding are largely behind them.
So, beyond the general high interest rates affecting everyone, what's specifically behind Riverside losing its once strong real estate glow? Are there unique local challenges playing a bigger role here?
There absolutely are. While the impact of high mortgage rates is universally felt, its effect in Riverside is particularly pronounced. A 7% interest rate on that $575,000 home means monthly payments pushing $4,300.
And that's before PITI, right? Before taxes and insurance.
That's just the principal and interest, exactly.
Yeah.
Before you even factor in insurance or property taxes.
Mm-hmm.
For many families in Riverside, especially those who are already stretching their budgets,
Right.
this figure has simply become unmanageable. Many families are finding that the total monthly housing costs simply exceed their budget capacity.
Especially with inflation on everything else.
Particularly with rising utility bills, persistent inflation eroding purchasing power, and that stagnant wage growth that just hasn't kept pace with these increased housing costs.
You mentioned investors earlier, too. Are they pulling back here as well?
Yes, that's another significant factor, perhaps distinct to a degree here. During the 2020-2022 boom, Riverside attracted a considerable number of real estate investors looking to capitalize on rapid appreciation and rental income.
Flippers and landlords.
Exactly. But with the market cooling and less aggressive price growth, many of these investors are now pulling out, or in some cases, are even being forced to flip properties at losses just to exit their positions.
Which adds more inventory to the market.
Precisely. Adding more supply to a market already struggling with excess inventory.
Are there other local issues? Traffic? Wildfires?
Beyond these financial pressures, yes. Riverside faces some specific local challenges that are becoming deal breakers for buyers. While its location, just outside LA, has historically been a strong selling point for affordability,
The commute factor.
the reality of worsening traffic congestion, the persistent threat of wildfires in certain areas, and a general lack of robust public transportation infrastructure are increasingly outweighing its perceived benefits.
So quality of life concerns are becoming more prominent.
Buyers are now prioritizing these quality of life factors more heavily when considering such a significant investment. Furthermore, there's a consistent flow of new construction actively adding supply.
New builds competing with resales.
Right. Builders are continuing to add new homes on the outskirts of the county, creating direct competition for existing resale homes, which are struggling to compete on price or amenities. This combination paints a clear picture.
So Riverside isn't collapsing, but the market is definitely losing steam fast. Buyers are cautious, sellers are frustrated, and that whole narrative of buy now or be priced out forever.
That's officially over.
Seems like it. If prices continue to slide and inventory keeps rising, 2025 might be remembered as the year Riverside's real estate glow finally dimmed, settling into a more tempered reality.
A necessary adjustment, perhaps.
Okay, let's head further inland to Bakersfield. This place used to be the absolute beacon of affordability in California, didn't it?
It really stood out. Median home prices around $385,000 made it accessible in a way few other places were.
It was the go-to spot for first-time buyers trying to get on the property ladder, retirees maybe looking for more bang for their buck, folks escaping the crazy high-cost metros.
It offered a tangible, accessible path to homeownership that felt increasingly out of reach elsewhere in the state.
But as we move into 2025, it seems even Bakersfield isn't safe from this statewide housing shift. The definition of affordable is really being tested.
Exactly. The market figures in Bakersfield confirm this shift. While it remains one of the more affordable cities in California, prices have indeed started to cool, dipping around 1.7% over the past year.
Okay, 1.7%, not a huge drop, but still a change in direction.
A change, yes. And it's combined with a significant surge in inventory, up by nearly 48%.
48%, there's that number again.
It clearly signals a changing market dynamic.
Yeah.
What we're seeing on the ground is that nearly 35% of listings are now offering price cuts.
Sellers trying to attract attention.
It's a proactive move.
Yeah.
And open houses, which once drew eager crowds, maybe generated multiple offers.
Yeah, lines out the door sometimes.
Now often see only a trickle of potential buyers. It reflects a profound drop in immediate demand and urgency compared to the frantic pace of just a year or two ago.
Here's the twist for Bakersfield, though, right? Unlike LA or the Bay Area, its current struggles aren't really stemming from an overload of luxury properties or an inflated high-end market.
That's correct.
It's suffering because even what was once considered affordable by California standards simply isn't affordable anymore for the local population. That feels like the core issue.
That's a crucial point, and it's the paradox. The affordability crisis here is amplified by those interest rates, still near 6.8%. Let's look at the numbers again. A 30-year mortgage on a $385,000 home.
The median price there.
Right. Even with conservative estimates for taxes and insurance, it runs about $2,800 a month.
Okay, $2,800 a month.
Now consider that for a city where the average household income is under $60,000.
That's a huge chunk of income.
A massive, often insurmountable financial burden. It consumes a disproportionate share of income, making homeownership a precarious proposition for many local families. It essentially makes affordable just out of reach.
And that's before other rising costs.
Exactly. This financial strain is further compounded by a myriad of rising everyday costs. Gas prices remain high, inflation continues to erode purchasing power, and perhaps most acutely felt across California, increasing homeowner insurance costs.
Insurance again. Wildfires and drought impacting Bakersfield, too.
Yes. Bakersfield, like many areas in the state, has been affected by local wildfires and persistent droughts. This has made insurance both more difficult to obtain and significantly more expensive, further straining already tight budgets.
What about the local job market there? What drives Bakersfield's economy?
The job market also plays a significant role. Bakersfield's economy leans heavily on its agriculture and oil industries.
Okay, ag and oil.
Both of these sectors are currently under considerable strain, impacted by fluctuating global markets and increasingly stringent state regulations.
Creating uncertainty for workers.
Economic uncertainty for a large portion of the workforce. This pushes potential buyers to wait things out, or maybe even consider options out of state where housing prices and long-term economic prospects might appear more balanced.
Is the rental market softening there too?
It is. The rental market is also experiencing a slowdown. Rents are stabilizing, in some cases even decreasing slightly. This directly affects investor confidence.
So landlords aren't seeing the returns they expected.
Homes are simply not generating the same level of cash flow for landlords as they did a year or two ago. This has led many landlords to back out of bidding wars on new purchases or to sell their existing properties outright,
Adding to that inventory problem.
contributing to the rising inventory and the overall market softening, yes.
So Bakersfield isn't in freefall, and it's still more attainable than many other California cities, relatively speaking.
Relatively, yes.
But it's definitely softening in 2025. The core issue seems to be that affordability alone, once its strongest selling point, just isn't enough to fuel robust market activity anymore. Buyers are cautious, money is tighter,
Across the board.
and it's quite possible that Bakersfield may see even more price drops before things stabilize and turn around.
It certainly looks that way. The pressure is definitely on.
All right, let's shift back towards the coast, to Ventura. Such a desirable spot. Dreamy coastal vibes, that surf culture, charming neighborhoods.
It's undoubtedly one of California's most beloved places to live. It really feels like a perpetual postcard, doesn't it?
It does. A place where many aspire to settle down, embodying a true slice of the California dream. But even this idyllic slice of paradise is feeling the pressure in 2025.
It seems no market, no matter how desirable, is truly immune to these broader economic forces.
Apparently not.
The data for Ventura shows a clear flattening, if not an outright potential downturn. Ventura's median home price currently sits around $820,000.
Okay, so still quite pricey.
Very much so. And after a wild, rapid climb during the pandemic era, prices are now largely stagnant. They've seen just a modest 0.4% increase over the past 12 months.
0.4%. That's basically flat.
Essentially flat, yes. A stark contrast to the recent years of double-digit appreciation. And many analysts are predicting that this plateau could very easily turn into a downturn by year's end if current trends persist.
What about inventory in Ventura County?
Inventory is another telling sign.
Yeah.
Ventura County, which includes places like Oxnard, Camarillo, and Inland Ventura,
Right, the broader area.
has seen a significant jump in available homes, up nearly 41% compared to last year.
41%. Homes sitting longer.
Yes, more homes sitting idle on the market rather than being snapped up quickly. The days on market metric is stretching past 36 days now.
Giving buyers time to think, negotiate.
Ample time. And in response to this slower pace, nearly 33% of listings are now showing price reductions.
33%. Not insignificant drops, but maybe not huge ones yet.
They might not be massive drops across the board, but they are significant enough to make buyers pause, reconsider, and crucially, to negotiate for better terms. It indicates a definite shift in leverage towards the buyer.
So, beyond the general interest rate concerns we keep talking about, what's specifically challenging Ventura's postcard-perfect real estate market? Are there additional unique factors at play, particularly for a desirable coastal community like this?
You're right, affordability remains a monumental barrier. With mortgage rates stubbornly near 7%, middle-income buyers are increasingly being priced out of the Ventura market. Consider the payments on that $820,000 median home,
Over $5,000 a month again?
hovering around $5,600. And that's before factoring in the increasingly significant cost of rising home insurance premiums.
Ah, yes, the insurance factor again. Is it worse near the coast or wildfire zones there?
It's a particularly acute issue in Ventura. Some coastal homes, due to their proximity to wildfire-prone areas and potential flood risks, are facing sky-high insurance hikes.
How high?
Rates jumping anywhere from 20% to 30% year over year in some cases.
20 to 30% increase on insurance. Wow.
It adds hundreds, if not thousands of dollars to annual housing costs, making an already expensive proposition even more prohibitive for potential buyers.
Any other unique Ventura factors?
Tourism. That's another distinct factor affecting Ventura. The cooling of its tourism sector. A thriving tourism industry has historically supported the local economy and, indirectly, the housing market, especially through short-term rentals.
Airbnbs and the like?
Exactly. However, with tourism slowing down, the demand for short-term rentals has decreased. That leads to fewer bookings and reduced profitability for landlords who invested in these properties.
So some landlords might be selling.
This dip in profits is causing some landlords to sell off their properties, further contributing to the available inventory. Additionally, new restrictions on Airbnb-type rentals in certain neighborhoods are adding another layer of pressure.
Making it less attractive for investors.
Less attractive for investors and potentially pushing more properties onto the long-term sales market.
So Ventura still looks like a postcard, right? It has that undeniable allure. But financially, the shine is definitely fading. With higher overall costs, fewer buyers able to qualify or afford the payments, rising inventory. The market is undeniably losing heat.
It is. It feels like a slow-motion correction for now.
A gradual adjustment rather than a sudden plunge. But if rates stay persistently high and buyer demand remains soft, Ventura could be in for a chillier 2025 than many expected, potentially bringing more significant price adjustments down the line.
It's a real possibility. Even Paradise isn't immune.
Okay, now let's head north to the heart of it all, Silicon Valley, San Jose. This place used to be California's undisputed golden goose, right?
Absolutely. A seemingly endless well of tech-fueled wealth, massive housing demand, and sky-high home prices that made the rest of the state look like a bargain basement by comparison.
It was a market that just defied gravity for so long, driven by the relentless growth of Silicon Valley. But in 2025, even this tech juggernaut is tapping the brakes.
Experiencing a slowdown that, frankly, few would have predicted just a few years ago.
It really felt unstoppable.
The market data confirms this undeniable slowdown in San Jose. Median home prices there recently peaked at around $1.4 million.
1.4 million median.
Median, yes. However, the trend is now slowly but steadily dipping. In early 2025, prices fell roughly 1.2% to 2% year over year.
Okay, 1 to 2%. On 1.4 million, that's still a decent chunk of change, but maybe not a crash.
Not a crash, but it represents a significant reversal of the previous upward trajectory. And analysts are projecting further softening as buyer demand continues to cool and available inventory steadily builds up.
Is inventory rising there too?
It is, up nearly 35% year over year, which indicates more homes on the market without a corresponding increase in buyers.
And homes sitting longer.
Significantly longer. In 2021, properties in San Jose were selling in under 10 days, often with multiple aggressive offers over asking.
Crazy times.
Now, that timeline is stretched closer to 35-plus days.
Giving buyers breathing room.
considerably more time to make decisions and reducing that sense of urgency. Consequently, roughly 30% of listings are now seeing price reductions.
30%. And bidding wars.
The once ubiquitous bidding wars are vanishing fast. A clear sign the market has shifted from that hyper-competitive seller's environment to one where buyers have more leverage.
That's a fascinating rebalancing, particularly for a market so intrinsically tied to tech wealth. Here's the twist, right? The very tech industry that supercharged this market for decades,
Creating unprecedented demand.
is now paradoxically creating these headwinds. How exactly is that happening?
It truly is an ironic turn.
Mm.
The tech industry, the undisputed economic engine of Silicon Valley, is undergoing significant shifts that are directly impacting the housing market. We've seen multiple waves of layoffs across major firms, Google, Meta, others,
Yeah, big names.
which not only reduce the immediate pool of potential buyers, but also erode overall buyer confidence. When highly paid tech workers face uncertainty about their future, they're understandably far less likely to commit to multi-million-dollar mortgages.
Makes sense. What about remote work?
That's the other side of it. The remote work culture, which initially drove a rush for larger homes, more flexible living arrangements, it's evolving. The shift in company policies, more mandates for returning to the office.
Fewer people need to live right there.
Exactly. Fewer people are feeling the urgency to buy million-dollar homes right in the heart of Silicon Valley to be closer to their workplace. Many are choosing to commute or live further afield in more affordable areas.
And the sheer cost, even for tech salaries.
The extreme affordability challenge is a huge factor, even for those still employed and earning good money. With those sky-high mortgage rates, still around 6.9% on a $1.4 million home, the monthly payment now demands over $9,200 per month.
$9,000 a month, just for the house payment.
And that's factoring in taxes and insurance, but not even touching HOA fees or the simply insane general cost of living there.
It's astronomical.
It is. That price tag, even for well-paid engineers, is becoming a real financial strain. The sheer financial burden is pushing many out of the market. Even with significant down payments, the monthly carrying costs are simply unsustainable for a growing number.
San Jose's substantial wealth cushion, though, will likely prevent a major crash, like we might see elsewhere. Right?
That's the general consensus. The underlying wealth is still significant.
But we're already witnessing a meaningful market correction. Even what were considered entry-level homes in this incredibly expensive area are now being priced down to attract cautious buyers.
Sellers have to adjust to the reality of these high rates.
So in 2025, San Jose's housing market looks more like a volatile tech stock itself. Expensive, yes, but no longer the guaranteed winner it used to be.
That's a good analogy. Expensive, volatile, not quite the sure bet.
If you're a buyer who's been patiently waiting for the dip, you may not get a full-blown crash, but you will absolutely get leverage, which is a powerful advantage in this kind of market.
Leverage they haven't had in a very long time.
Okay, let's talk about Sacramento. This city was truly the undisputed sweetheart of the pandemic housing boom, wasn't it?
It really was. As Bay Area buyers, eager for more space and those lower prices, looked inland, Sacramento absolutely exploded.
How much did prices jump back then?
Prices jumped nearly 40% from 2020 to 2022, a phenomenal rate of appreciation that really transformed this city's market.
40% in 2 years. Incredible. But in 2025, that boom is undeniably going bust. The party, it seems, is over.
Sacramento is now resetting. The sharp market shift is evident in the numbers. Median home prices now hover around $495,000.
Okay, under $500,000 again? What was the peak?
After peaking near $540,000, they have dropped about 2.5% year over year from that high point, and analysts are projecting more softness throughout the remainder of the year.
So a clear downward trend after that rapid ascent.
Okay.
Inventory surge here, too.
Oh, yes. The most significant change is the regional inventory surge. The number of homes for sale in Sacramento has increased by over 46% compared to 2024.
46%. These numbers are consistently high across the state.
It's a widespread phenomenon. This substantial increase in supply means that homes that once generated fierce bidding wars,
Multiple offers, way over asking,
are now lingering on the market for 35 to 45 days, giving buyers ample time to assess properties and negotiate.
and price cuts following suit.
In response, yes, a significant portion of sellers are making adjustments. About 36% of all listings in Sacramento have seen price cuts,
Which neighborhoods are seeing this most?
particularly in neighborhoods that saw that explosive growth during the pandemic. Places like Elk Grove, Natomas, and Rancho Cordova.
Areas popular with those moving from the Bay?
Often, yes. The energy has fundamentally shifted from that desperate buy now or lose out mentality to a more patient wait and negotiate approach.
Yeah.
It reflects the newfound power of the buyer.
That dramatic cooling isn't just about prices, though. It feels deeply tied to an affordability ceiling that Sacramento has finally hit. What specific economic and buyer behavior shifts are at play here, especially with the Bay Area's influence now changing?
It's absolutely right. The core issue is affordability, especially now that the initial massive influx in the Bay Area has subsided. With mortgage rates still lingering near 6.9%, the monthly payment on a $495,000 home, it's around $3,800.
$3,800. Still a stretch for many local incomes there.
For many families in Sacramento, yes. Where the average household income isn't as high as in some of the tech-driven coastal cities, that monthly payment is pushing the absolute edge of their financial capacity. They're simply tapping out.
What about Sacramento's economy? Is wage growth keeping up?
Sacramento's economy, while stable, is largely driven by government jobs and healthcare, critical sectors, but they typically don't generate the kind of high wage growth seen in tech cities.
So local buyers are hitting pause.
This lack of rapid wage appreciation means that local buyers are hitting pause, unable to keep pace with the elevated costs of home ownership. And then there's that significant reversal of the Bay Area effect.
People moving back. Or just not coming anymore.
Both, to some extent. Many of the buyers who flooded Sacramento in 2021 and 2022, seeking affordability and space, are now rethinking their moves. Some are selling their properties, maybe taking a smaller profit, or even a loss. Some are choosing to rent instead of buy. And many are simply watching the market slide back toward a more realistic pre-boom state.
So that external push is gone.
The reduction in the influx of high-income buyers from the Bay Area is a major factor in the current slowdown. Furthermore, investor activity is also fading fast.
Same reason as elsewhere, rents leveling off.
Exactly. With rents leveling off and fewer opportunities for lucrative short-term rentals, the investment appeal that once buoyed the market has significantly diminished. Investors are no longer as active or moving in other sorts of demand.
The good news, I suppose, is Sacramento likely won't crash like it did in 2008. The underlying fundamentals seem different this time.
Agreed. The lending standards are much tighter now, for one thing.
But it's definitely resetting. Moving to a more sustainable, maybe more normal market. For buyers with patience and solid financing, 2025 might genuinely offer the best deals in years in Sacramento.
It could be a good window of opportunity.
Just don't expect the wild days of $100,000 over asking offers or those frenzied bidding wars to return anytime soon. Those seem to be firmly in the rearview mirror.
Very unlikely in the current climate.
All right, let's head south again, all the way down to San Diego. California's eternal paradise, right? Sunshine, surf, tacos.
And some of the most desirable real estate in the entire country. It's always been seen as a kind of safe haven for property values.
Yeah, a market that seemed almost immune to significant downturns because of its unparalleled lifestyle appeal. But even Paradise is cooling off in 2025.
It shows that even the most coveted locations are subject to economic realities and that breaking point of affordability.
So what are the numbers looking like in San Diego?
The market changes there are indeed significant and warrant close attention. The median home price in San Diego sits around $875,000.
Okay, close to LA levels.
Getting up there. However, after years of non-stop, almost linear gains, we're finally seeing prices dip. Over the past year, values have dropped roughly 2.1%.
2.1% down. Again, not a crash, but a definite shift.
A notable shift for a market accustomed to constant appreciation. And there's potential for that slow slide to accelerate if interest rates remain elevated. But what's even more telling is the inventory.
Let me guess, way up.
Way up. It's up a dramatic 61% year over year.
61%. That's the highest jump we've talked about yet.
It's a staggering increase. It means that buyers now have more than 6,000 homes to choose from in the county.
Compared to what?
Compared to fewer than 3,800 just last year.
Wow, that sudden abundance of choice drastically shifts the power dynamic.
Absolutely. And sellers are undeniably feeling the pressure. Nearly 40% of listings in San Diego have seen price cuts in 2025.
40%, similar to LA.
Very similar. And the time homes spent on the market is climbing past 40 days.
Compared to what previously?
Just 2 years ago, that number was closer to 10 days.
10 days.
Indicating a rapid sale environment with strong buyer urgency. The current extended selling period highlights a significant slowdown in demand and an increase in buyer selectivity.
What's truly causing this slowdown in America's finest city? It feels like it must be more than just interest rates if inventory is up that much.
It's a confluence of pressures challenging even San Diego's intrinsic, highly desirable appeal. Part of it is that classic affordability fatigue we've
It's
discussed.
just hitting the wall.
Exactly. But it's acutely felt here given the high price points. Mortgage rates near 7% mean monthly payments on that $875,000 home can easily reach $6,000.
6,000 a month.
Even for dual-income households, which are common in San Diego, with
Right.
the average household income hovering around $85,000, the math just doesn't add up anymore for many.
Even with two incomes, that's tough.
The sheer cost of servicing that debt, coupled with the overall high cost of living in the region, is pushing many potential buyers out of the market.
How's the job market holding up there?
The job market is also undergoing subtle but important shifts. While San Diego's core sectors, military, biotech, tourism remain strong and provide a solid economic foundation,
Yeah, those are big pillars.
we are seeing layoffs in tech-adjacent roles. Additionally, shrinking tourism revenues, perhaps due to broader economic concerns or changing travel patterns, are cooling the overall economic buzz and confidence.
Less buzz, less urgency to buy.
Precisely. And another factor contributing to the cooling is the tightening of short-term rental restrictions.
Airbnb rules changing there, too.
Yes, these new regulations are turning off Airbnb investors who once flocked to the area, seeking to capitalize on the robust tourism market, with fewer investors entering or existing ones looking to exit.
It removes another segment of buyers that previously contributed to competitive bidding and price escalation.
You got it.
So, despite all this, San Diego is still incredibly livable, desirable. Its appeal remains strong.
Undeniably.
However, it's clear that the price party is definitively over. The market is unmistakably tilting toward buyers, and 2025 may be the first year in a decade where the strategy of wait and see actually beats jump in fast.
It's a possibility. Deals are emerging for patient buyers.
And while we're certainly not calling it a crash, we're definitely calling it a correction. Perhaps one best enjoyed with sunscreen as you consider the emerging opportunities.
Well put. A correction with sunscreen.
Finally, we arrive at San Francisco, the legendary tech capital, city of steep hills, stunning bridges, and infamously, even steeper housing prices.
The ultimate California market in many ways.
For decades, it felt like the untouchable crown jewel of California real estate, a market driven by seemingly limitless tech wealth and global appeal. But in 2025, even the crown jewel is quietly cracking.
Revealing vulnerabilities that seemed almost unimaginable just a few years ago.
What are the numbers showing in SF proper?
The market shifts in San Francisco are quite dramatic and underscore the unique pressures at play here. Median home prices have fallen to around $1.12 million.
Down from what?
Down nearly $40,000 from 2024. That represents a 3.5% year-over-year decline.
3.5%. That's one of the larger percentage drops we've discussed.
It is. And it's even more pronounced in certain condo markets and maybe some fringe neighborhoods that saw the most speculative growth. The Bay Area boom that once made San Francisco's real estate almost untouchable is clearly reversing course.
What's driving it there? Similar factors.
The confluence of widespread tech layoffs across major companies, a continued remote work exodus, and the sheer affordability wall that has been built up over years are hitting San Francisco particularly hard.
Let's break down that affordability challenge again, just for SF context.
Okay. With mortgage rates near 6.9%, a standard 20% down payment on that average $1.12 million home still leaves you with a staggering $7,500 per month mortgage payment.
$7,500 a month, before anything else.
Before you factor in HOA fees, property taxes, and the generally insane cost of living for everything else. For many, even the well-compensated, the math simply doesn't compute anymore.
People are just done.
Frankly, buyers are just done. They've reached their breaking point with the exorbitant costs. This is reflected in the rising inventory. Supply is climbing fast, up 43% over the last 12 months.
43%. Homes sitting longer, too.
Much longer. Homes that once received 10-plus offers in mere days are now sitting for 45 to 50 days without any action.
50 days. That's a huge shift from instant sales.
A clear indication of vastly diminished demand and urgency. Furthermore, more than 35% of all active listings have undergone price reductions.
Sellers getting desperate.
It seems that way. Sellers are realizing they can no longer command the inflated prices of previous years. Even once hot, desirable areas like Noe Valley and Bernal Heights
Always super competitive.
are now seeing significant markdowns.
It's clear the numbers are shifting. But beyond the raw financials, there feels like a deeper story about San Francisco's evolving appeal. That broader quality of life narrative seems really prominent there.
Absolutely. That's contributing significantly to this market cooling and, in some cases, an actual exodus of residents. The remote work trend has had a profound and lasting impact that's uniquely felt here.
People realizing they don't have to live there.
Exactly. Many former San Francisco residents, particularly those in tech, are no longer tethered to the physical office space. They realize that $1 million in places like Boise or Austin or Sacramento
Buys a mansion.
buys a mansion with sprawling space and a yard, not a one-bedroom walk-up in a dense urban environment. This means a significant portion of the traditional buyer base has simply left the city, and they're not rushing back.
And the quality of life issues we hear about.
Compounding this, San Francisco has grappled with highly publicized and pervasive quality of life concerns. Issues like homelessness, persistent safety concerns in certain areas, frustrations with public transit. These are driving even long-time residents, those deeply rooted in the city, to consider leaving.
Making the cost harder to justify.
These factors, while not directly financial, contribute to a sense of diminished appeal and make the extraordinary cost of living less justifiable for many. When the lifestyle benefits no longer outweigh the financial burden and urban challenges, people reconsider.
So San Francisco certainly won't collapse completely. It's still a global hub, right? Center of innovation, unique place.
It absolutely is, and it still attracts talent from around the world.
But it's no longer untouchable. That much is clear. The almost mythical shine has dulled, and for the first time in a very long time, real estate here genuinely feels negotiable.
Truly negotiable.
If you've been waiting for the impossible to happen, waiting to buy a slice of San Francisco at a rare discount, 2025 may just be your chance to finally scoop up that dream property. It's a new, more tempered reality for the Golden City.
The significant opening for some buyers, potentially. #tag outro.
Okay, so we've truly done a deep dive today into California's shifting housing market. We've peeled back the layers on 9 distinct cities. Quite a tour.
A comprehensive look, definitely.
What really stands out when you look across all these diverse markets, from Los Angeles's flickering glamour to San Francisco's quietly cracking crown, is a clear, undeniable pattern of convergence.
It's not just isolated incidents, is it?
Not at all. It's a systemic shift that's reshaping real estate dynamics across the entire Golden State. At its core, it's a story of, well, first, stubbornly high mortgage rates making home ownership a struggle across all price points.
That's the foundation.
Second, a significant rise in inventory that's finally giving buyers some much-needed power, some breathing room.
A rebalancing, as you said earlier.
And third, local economic factors, and maybe more importantly now, quality of life factors playing a much larger, often surprising role than ever before.
Those local nuances are really coming to the forefront. If we connect this to the bigger picture, this isn't just a fleeting blip on the radar or some temporary fluctuation.
Feels more fundamental.
It feels like a fundamental resetting of expectations. We're moving away from that frenzied, hyper-competitive atmosphere that characterized the past few years, where bidding wars were standard, homes sold sight unseen sometimes.
Yeah, those crazy stories.
This extensive analysis clearly shows how quickly market dynamics can shift when affordability reaches its absolute breaking point, and when external factors that might have once seemed peripheral, like those rapidly increasing home insurance costs,
A huge one.
or the widespread adoption and then the subtle reversal of remote work trends, become major dominant players in the market.
They're not side issues anymore.
Not at all. This deep dive across these diverse markets highlights a universal truth. Even in highly desirable locations, there are limits to what buyers can financially bear.
Breaking point.
Exactly. Which raises an important question for all of us, whether you're a homeowner, a prospective buyer, or simply an observer of the economy. What does this deep dive tell you about the profound power of seemingly small changes, like a single percentage point rise in interest rates?
How it just ripples through everything.
To ripple through an entire economy and fundamentally impact that foundational dream of homeownership.
It's a powerful reminder. So as we wrap up this deep dive, here's something to consider. If the Golden State's real estate crown is starting to crack, if its most iconic markets are undergoing significant corrections, what does that mean for the very idea of California dreamin'?
A big question.
Will this correction lead to a more sustainable, maybe more accessible housing market for a broader range of Californians? Or will it simply redefine who can truly afford to call this state home, pushing even more people to seek opportunities elsewhere?
The stratification question.
Yeah. And what long-term, perhaps even surprising changes might we see in the years to come and how cities adapt to these new market realities? How will that impact the social and economic fabric of California?
Lots to think about there. How cities respond will be crucial.
Definitely something truly significant to mull over as you go about your day.